Our mission at SD Bullion is clear. The lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Jubin with the SD Weekly Metals and Markets Wrap. On a week that has seen gold and silver explode to the upside, silver bursting through $15 nearly to $16, gold through $12.50. We invited our good friend and fund manager Dave Kranzler back on the show. Dave, great to have you back with us.
Thanks for having me. I love chatting with you guys. Appreciate the opportunity.
Well, let's get right to the price action in gold and silver, Dave. And let's start off with the LBMA silver fix of about a week and a half ago. Was that the ultimate bottom signal?
I think it is. First of all, I just want to say I think it's just an ultimate embarrassment to the idea that we have free markets, because it was so obviously a manipulated fix, and it just reflects the extreme degree of fraud and corruption that's completely embedded the Western Hemisphere. And what I think happened is that I've had a theory all along. Well, I'm not the only one, and it's not necessarily my original thinking, but I think that the ratio of short interest in paper silver is even to underlying deliverable physical silver is even higher than it is for gold. I mean, gold has been generically thrown out there. I think the first time was around 4 or 5 years ago by Jeffrey Christian, which he basically threw out there that it was 100-to-1 paper to physical ratio, and he later backpedaled on that, but he was caught at his own BS because one of the finance ministers in India referred to a 93-to-1 paper to gold ratio. So that kind of confirmed that the paper to gold ratio for gold is at least 100-to-1. I've always thought, and I'm not the only one, there's plenty of others who think that it's even worse in silver, because I think before we got into all of this, I think they had already found themselves in a bigger supply-demand deficit with silver than they did with gold. Part of the reason is because all the central banks unloaded their silver in the 60s and 70s, just completely got rid of it, and then they started unloading their gold. So I think what happened there is that the insider bullion banks knew that they were at the point where they were not going to be able to push the precious metals lower, despite all the negative propaganda we had for the last 6 months that just seemed to intensify as the further we went into 2015. I think they also saw obvious rising demand for physical that could be delivered, which would be into China, into Russia, into India, but also into the retail system here. I mean, we saw a huge surge in demand, obviously, last summer, and it basically told everyone that the market, they've taken the price of silver down too low. I mean, you can always solve the supply and demand equation by stopping the manipulation and letting the price rise and see where it settles out, and that's how you balance out supply and demand. So I think what happened is I think it got to the point where they just realized they probably had one last shot to grab as much physical silver as they could at as cheap a price as possible, and that was what we saw in that fix, because they fixed the price, and all the silver that was offered for sale before the price fix clears at that price. And the people who, the bullion banks and the guys who got, I think what was it, like $13.58, I think was the fixed price or something like that. Whoever was on the receiving end of that got a lot of silver at a price that was close to $1 below where the futures were trading at that point in time. And whoever sold it, which is largely silver producers, I mean, they basically were raped by these criminals on the LBMA. And I think that is what marked the bottom. And as we've seen since then, we've had just a torrid rally in both gold and silver.
Dave, do you think that there is also the probability, and whatever probability that may be, that in fact, given the timing of this incident, that it may have also been trying to rescue somebody, some financial actor in a precarious position because of options exposure.
Well, you mean like Deutsche Bank?
Yeah, now that you mention it.
To me, it reeked of desperation, and it wasn't necessarily the desperation of bullion banks who knew silver was going higher and wanted to get long silver. I think it was the desperation of entities who were on the long side of LBMA forwards, silver forwards, who were knocking on the door saying, look, we want our silver, we're going to take this public. And so I think that was basically a last gasp silver grab so that they could bail someone out who didn't have enough silver to deliver into paper commitments.
Right. Well, given what's going on this week and the evolution since that point, that inflection point, where do you think we are in the market, and where is your sense as far as the current state of silver and gold? You know, long term, we all know it's going to definitely go higher and whatnot. What do you think in short term, given all of the intense movement that we've seen in all markets in February?
Yeah, I hate being put on the spot for short-term price forecasts. The markets.
Yeah, let me clarify too. I'm not really calling for you to say, hey, X, Y, and Z is going to happen and forecasting prices and such. I'm more after, what's your sense as far as the money flows and what's happening in terms of the sentiment and what is being in fact signaled by the various movements in our markets. You know, stocks crashing, precious metals catching much more safe haven bid, etc.
Sure, I know what you're saying. So I guess, you know, just to preface it, as part of what I think would be empirical evidence that there's a bigger problem for the paper shorts in silver than there is for gold. And it's just something I've noticed, and it may be since the summer. Again, I haven't made it a scientific study where I write down my thoughts and the data points every single day. But just generically, I've noticed for at least the last 2 or 3 months, and maybe even longer, probably longer, that on days when gold and silver are moving higher, gold outperforms silver. So, and everyone's noticed that. Gold has been outperforming silver. The gold-silver ratio is I think today it's like 78 or something. But on days when gold and silver get hit, silver outperforms gold. And today is a perfect example. So, for instance, depending on what starting point you're using to measure gold and silver, I use the front month futures. Gold's down 1%, silver's down 0.67%. And it's almost, I mean, I bet you that's at least a 90% observation where silver outperforms gold on the downside. And I think that's evidence that there's a very strong bid for smart money or institutional entities, i.e. bullion banks who are short paper silver. They're trying to buy silver on any kind of weakness.
Yeah, I'm glad you articulated that.
They're not as aggressive at chasing it on strength, because when they have to pay up to buy silver, it means they lose more money on their shorts. So they're always more aggressive on the downside because it saves them money as they cover their shorts.
Yeah, I totally agree. I see the same pattern, and I think you're right. And one of the things that even furthers the argument is that when you're in a deflationary spiral and people are freaking out and the stock market is going down, and you would imagine that silver would actually amplify to the downside when gold is going down.
Correct.
And we don't see that.
That's right.
It further substantiates the theory you're working with.
So, I mean, just in terms of maybe a short-term, long-term outlook here, I mean, I mentioned it on my blog yesterday, but I think silver will be the trade of the decade, meaning, measuring it from 2010 to 2020. And I think we all know that on a fundamental basis, gold is insanely cheap. So let's just say that on a free market trading basis, gold should be at 3,500 instead of 1,250, 1,235 where it is today. Silver relative to gold, just based on using the 78 times gold silver ratio, is insanely cheap by any kind of historical yardstick, and you can take that out over any time period you want to, and you can mark it from when the gold standard ended, the great crash, the stock market crash of 29, the founding of the Fed, etc. The long-term gold-silver ratio, or at least it always, over the long run, converges to about 16, and it even goes lower than that if you go back to, for instance, Rome, where it was fixed at 8 times. And that was based on the ratio of how much silver is pulled out of the ground versus how much gold they were pulling out of the ground. Well, guess what? I think the last numbers I saw for right now is that they're pulling out about 9 ounces or 10 ounces of gold for every ounce of silver. I'm sorry, 10 ounces of silver, 9 ounces of silver for every ounce of gold. So it would make sense, just from an economic standpoint, that you would have if you're going to say silver is a monetary metal and it should be valued on the same basis as gold, you should have about a ratio of 8 or 9 to 1, right?
Yeah.
Well, guess what? Fast forward to the modern industrial era, and about 70% of all silver used is used in industrial and manufacturing processes, which means that silver is a lot more scarce than gold. So if you're going to treat both as equivalents in terms of monetary metals, you can actually make the argument that the gold-silver ratio should be somewhere between, say, 8 or 9 to 1 and 1 to 1. And again, that's something that I've been thinking about a lot lately, but I remember reading articles about this 15 years ago when I first started getting into this market, so it's not necessarily my original thought.
And the whole concept of peak gold applies to peak silver even more. Like the falling grades of discoveries found over the 100-plus years of modern mining or so demonstrate the trend. Getting harder and harder to find very rich, large sources of silver, and then layer on top of that any kind of further crash in industrial metal space with the byproduct silver coming to market, 70% or so being predicated on byproduct mining. The forward supply picture has just been seriously mauled, and even if we were at like $20 silver next month and stayed there, the damage has been done.
Yep,
it takes a long time to reboot a sector.
That's right. And so just to sort of circle back to your original question, when we were chatting about this before we started the show, is that, I think we all agree that we're probably entering the third leg of this secular bull market in the precious metals. And, notwithstanding and aside from the fact that, the rule of thumb is that the third leg's always the best gains and the shortest in duration. But in terms of what I think is going to be the fundamentals, because I like to look at underlying fundamentals, because ultimately everything converges on underlying fundamentals. Throw the technicals out over the long run. Besides the fact that we're all dead, everything, and that's a fundamental law of human nature, right? We all die eventually. So I like to tie it to fundamentals and what I think is going to start going on. And the reason I thought about this is that someone had showed me an Elliott wave analysis, and I really can't stand the Elliott wavers. I don't really think there's any basis for their arguments other than just drawing silly lines on charts or silly waveforms. But he showed me an Elliott wave forecast that said the dollar had one more big up leg, and then it was going to go into a cliff dive. And so my mind started spinning, and I'm thinking to myself, okay, well, if the dollar goes down, that means it has to go down against either the euro and or the yen, because those two currencies are about 80% of the dollar index.
Okay.
And then I'm thinking to myself, why on earth would someone want to buy euros versus dollars, or why on earth would someone want to buy yen versus dollars? Because all three of those countries are, pretty much equally within the same degree of catastrophic financial condition. Way too much debt, tanking economies, too much sovereign debt, too much corporate debt, too much, they all look the same from a fundamental standpoint, which is bad. So why would you want to own any of those currencies? And then I started thinking to myself, well, you know what? Maybe the smart money is going to look at this and start and look for a contra fiat currency. Because all of fiat currency, the only thing backing a fiat currency is government promises, and all these governments are broke, and they have been broke for a long time. So the most tried and true contra fiat currency is gold and silver.
Right.
So I think what's going to happen is, to start this third leg of the bull market, I think you're going to start to see, I mean, I think you had the really, really, really smart money between 2001 and 2011 were buying as much gold and silver as they could. And now I think you're going to start seeing the smart money and the smarter high net worth people look at this and say, geez, I don't want to own any of this stuff. And I think the stock market's done going up, so I'm done playing that rigged gambling game. I think I'm going to start converting my fiat currencies into precious metals, because I don't see where the dollar or the yen or the euro or any of these other fiat currencies represent anything near what I would call a safe haven of wealth storage. And I think that's what we're starting to see now. And I think that's probably part of the motive behind that just utterly fraudulent LBMA silver fix. Like I said, I think it was their last gasp to convert some of their paper obligations into real physical before this thing starts to take off.
And then bringing that up to trading for this week, I mean, basically what we see is the positioning and posturing amongst the central bankers and policymakers to begin the probable facilitation of the dollar to move downward in the rotation. Jim Rickards actually describes it as like passing the canteen and taking a swig from the currency war canteen. And, you know, we've seen these overlapping periods, but nonetheless, periods where one central bank will take the brunt of currency devaluation, and then it'll rotate to the Bank of England, Japan, etc. And the United States, for the most part, was the first mover in this crazy, reflation effort since the crash. And I think at this stage now, and even when you look at the laboring of the heavy chart action for the DXY, the dollar index, it suggests as well that when we hear Yellen all of a sudden coming out and talking about, well, maybe we might have to consider negative rates earlier this week, all of that is in part related to the currency war stratagems of these policymakers and how they actually are trying to keep all the spinning plates up. And I think there's counter trends as well, because the third world debt requiring servicing and the pressure that the dollar created earlier kind of has this multi impact to various markets. It just kind of amplifies itself. So when the commodities fall down, it pressures the third world countries that need to service their dollar denominated debt, and on. These things just kind of interact with each other, and it creates a further deflationary process in the global financial system, particularly the shadow banking system. You can see the transmission through Glencore to the Deutsche Bank, et cetera. I mean, these things are in part driven by these dynamics that we see in the currency markets. And there's definitely a brand new, fresh appreciation amongst people looking towards the United States to launch their next phase of currency war. And I think that's part of what's going on here. This week we saw a huge move in gold, and it was in part a reflection of negative interest rates being in our future, and then what that also means for the dollar.
I think that's right, and again, I think that kind of supports my theory that we're going to start seeing a mass movement of capital out of fiat currencies into contra fiat currenties. First and foremost, being gold and silver. I mean, for a time, gold was for a time, dollar afforded some safe port, an illusion nonetheless, but for a period of time it was taking in a lot of this flight capital. And when they change the policy, because they have to, because they can't
in order to do further currency debasement within Japan, you would end up hurting the economy even worse than it already is, and they're cognizant of this stuff. And the same could conceivably be the case with Europe, given what's going on in the shadow banking system, because, trying to boost exports via devaluation at this stage of the game just isn't going to work. All it is a race to the bottom.
I agree with that.
Let's talk a little bit about the physical side. The U.S. Mint's already sold 8 million ounces of Silver Eagles in the first 6 weeks of 2016. That's it really is an astonishing number. They're on allocation. We reported a couple of weeks ago comments from the largest AP in the country that the head of their trade desk said that he foresaw allocations to continue likely throughout the whole first quarter at least, and I don't see any way that won't happen right now with the demand we're seeing across the market. If these numbers continue for the entire year, you're looking at about 70 million ounces just in Silver Eagles for 2016, which would shatter previous records. Obviously, it's a little early to say that it's going to continue for the whole year, but this is with allocations. Neither the U.S. Mint or the Canadian Mint shows any intention of actually increasing output to meet demand. Ho-hum, we'll keep cranking out 1 million coins a week, and if the market demands 5 million, 10 million, who cares? We'll pat ourselves on the back because we're running the presses Monday through Friday, 9 to 5, except for the post office holidays.
It should be pointed that it's a profitable enterprise. They have every incentive to sell more coins. The problem is they don't have the silver. And that's the doggone truth.
It brings the question, as we were kind of chatting before the show started, we've seen this week lines around the block to buy gold, and the financial crisis really isn't even underway yet. What are we looking at potentially? It's, as Eric, you mentioned before the show, it's puts the potential for shortages in a whole new mind frame.
Yeah, to flesh out our previous conversation, for those that weren't the fly on the wall proverbially, back in 79, 80, by the time gold hit, what was it, $819 or something like that at its peak, we were seeing lines of Scotiabank and throughout Europe, and people were really going berserk in the third phase of the blow off top of a traditional bull market. And bull markets tend to go in the 3 phases, as we talked about before, Dave mentioned. And it's kind of weird when we see people line up to get physical now, when it kind of is fair to say that we're in the beginning of the third phase of a bull market move. That's definitely qualitatively different, and it reflects I think, as Dave was saying earlier, physical conditions being just so much more tight. And back then as well, there weren't a huge number of people participating in the marketplace because it was mostly a Western-based move. And now we have a global interest in gold and accumulation of silver and the wherewithal to actually purchase a whole heck of a lot because the Asian countries are so much more wealthy now.
What's your thoughts, Dave? I know that comments yesterday, you remarked that you expect the shortage that we'll see this year in physical metals will vastly exceed what we saw last summer.
I think there's a huge shortage, and I think they know it, and I think their backs are up against the wall. This mint allocation is just a pathetic apology to try and cover up the fact that they can't get enough silver at this price point to satisfy just retail demand. And this is retail investors we're talking about, and we're only talking about a very, very small sliver of the population. We're not going to see the real rush by retail into physical gold and silver until this thing's almost over and it's too late. And I think the smart money and some of the institutional money is starting to say, hey, I got to get out of this paper crap and get into physical gold and silver. As you had mentioned earlier, Doc, and the Mint saying that they upgraded their production equipment and they've moved it all to West Point. Well, wouldn't you think, given what they know about the market, that if they were going to spend the money to upgrade their equipment, they'd also spend a little bit extra money and put in the ability to increase production capacity? I mean, that's how any other business in the world would operate. So what it's telling us is that the market price of silver is far too low given the level of demand right now. And if one way to stop the allocation problem or the allocation issue, why don't they stop manipulating the price of gold and silver, and let's see what the natural market price would be. And I guarantee you there's not going to be an allocation problem at the mint anymore. So I think as this third leg of the bull market continues on, I think we're going to start to see the supply demand equation become even more imbalanced and become a lot more severe. And I suspect that before this is over, people are going to be paying 100 or 200% premiums to get their hands on an ounce of silver or an ounce of gold, because that's how worthless paper currency is going to become. I mean, we saw that in 2008. I think there was a couple days in there, Doc, you might remember this also. I think there was a couple days in there where premiums on Silver Eagles were close to 100%.
2008, yeah, when silver was trading down towards $8, even at the monster box,
right.
Even at the monster box level, I think it was trading somewhere about $14 an ounce for large stackers. So, yeah, you're right. I mean, it was close to 100% back in 2008 when really we didn't have the maturity of what the type of crisis that could be coming.
And those premiums were up and running for almost 2 months. It wasn't just a couple of days.
Well, there were high premiums for a couple months, but I think that when they were actually up as high as 100% was not very long. Because I remember specifically, I was buying mint boxes off of Tolving at, say, spot plus $4 and flipping them out on Craigslist at spot plus $6.
Yeah,
and that was before a lot of people got involved in the coin brokering game. Now there's other guys that are doing it on the Denver Craigslist, and they almost match the online prices.
Yeah, if memory serves, I think we had at least a 3-month period where the premiums were well in excess of 50% for Silver Eagles.
Yes, absolutely.
And at the month, for almost a whole month, like 20 days or so, we actually were in that area of near 100% premium. So It wasn't, it's like one little quirk or whatever. It was something that happened over the course of many, many months and spoke to the broken nature of the physical market.
That's right, and I think this time around it's not going to be 2 or 3 months of high premiums. I think it's going to eventually become a permanent feature of this market. Especially, I mean, if you've got maybe 1% of the U.S. public knows about precious metals and is trying to buy precious metals, what's going to happen when that goes up to 5% or 10%?
Yeah. Either that or the paper shenanigans end up breaking the COMEX and they have to take evasive actions.
The other thing, guys, that I think you're going to see happen is there's going to be a bifurcation in the price. There's going to be, for physical, I'm talking, there's going to be a available for immediate delivery price, and there's going to be a put yourself in the queue price.
Yeah, first class seats in the airplane versus baggage.
Right. I mean, if you want coins that are actually in our vaults today, here's what we're offering them at. If you want to put yourself in the queue behind the 89,000 other people that are lining up for the next available allocation from the mint, and right now we're estimating if the mint continues their allocations sometime in August of 2028, here's your premium. So I think that's what you'll see in the market when the shortage reaches those kinds of levels. And
Doc, Wall Street's going to package that and market it as a service.
Exactly.
Product differentiation. You pay more, and it'll be an improvement. It'll be financial service engineering improvements.
Well, here's actually a good way to bench this that I just thought about. I mean, think about it in terms of Super Bowl tickets. This is a good example of crowd mass psychology. People were paying between 5 and 10 times face value for Super Bowl tickets. Okay, now that's for a one-day event that you come away with some memories. So what kind of premium are they going to be willing to pay for something they can hold in their hand and that represents real money and real value, and something that they can take and hold in exchange for something else of value down the road? I mean, you can't really exchange Super Bowl memories for any kind of value other than personal self-satisfaction or whatever.
in under conditions of economic turmoil and financial market crash.
Right, and no one's going to care about the Super Bowl when this thing collapses. So Doc, I just wanted to mention one of the subscribers to my short sellers journal made several $1,000s on some Amazon puts, and he was emailing me yesterday. He's like, "Well, should I sell half and hold on to the puts?" I said, "Do this." I said, "Sell all of your puts, take the profits, buy a mint box of Silver Eagles, and take whatever's left over and buy a further out month further out of the money Amazon put and let it ride." And his next question was, "Oh, well, how do I buy silver?" And
oh, wow.
I sent him to your site. I said, "Well, as far as I know, this is probably the best place in terms of premiums and reliability on the internet to buy silver." And I said, "Take your money, get online, and buy a mint box from Silver Doctors." So hopefully,
I'm kind of curious.
He's gonna take my advice.
I'm kind of curious with that example you're speaking of. Are you noticing new people coming to the precious metals space because of your work, and you got a pretty decent barometer of sentiment based on that? So what's going on? What do you see?
I've had a lot of subscribers have in fact emailed me questions about mining stocks and buying gold and silver. Most of the people that are subscribing to the Short Sellers Journal are interested in, they see the same thing we do. The S&P is going to go from 1,800 to 600 at some point. How, what kind of zigs and zags it takes, it's impossible to know. And a lot of them don't want to short stocks outright. They want to use put options. So my weekly reports are fairly intensive in terms of using or showing suggestions on what I would do if I was going to use options to short a stock. I mean, my personal preference is to short a stock, because then you're not fighting just market volatility. With options, you're fighting market volatility plus you're fighting the calendar. If you just short a stock outright and you leave yourself margin room to add to your short, if you get some upside volatility in the name that you're short, you can hold on to the short forever, and eventually you're going to be right. Some of these stocks, like Beazer Homes, when I originally put my big research report out on it, it was at 18. I shorted it there, ran up to the low 20s. Well, guess what? Beazer is at 6 now in the space of about 18 months. And that's the idea here. But the other thing that I've kind of, at least for now, is I will occasionally throw in a mining stock idea into the weekly mix of ideas, because for me it represents a contra stock market trade. So, for instance, at the end of 2008, we saw for about a 6-month period the mining stocks moved in the exact opposite direction as the stock market did. The mining stocks went up, the stock market went down. So if you don't like shorting stocks, buy mining stocks, because you're going to get the same result. So that's kind of how the service works. It's a weekly report. I come up with typically what I call a long-term short sell idea, and then what I call sort of a quick hit. That's here you might be able to make a quick 1-week profit if you want to buy near money puts on this near money puts on this stock. It went up this week for no reason. I think it's going to fade. Obviously, it's predicated on what the overall stock market does. So I do that. And then I usually throw in some additional commentary, and then sometimes some bonus commentary. Like I've had some bonus commentary on how to trade Amazon. I've put in one emerging junior exploration silver stock. I think I've had 8 issues of this. Yeah, I think it's been 8 or 9 issues. So on one week I threw in a junior silver mining stock that I think has the capability of going from 10 cents to $1 if silver does what we think it'll do. And then at some point, when I can allocate enough time to make sure I do a good job with both, I'll probably roll out a mining stock journal. So subscribers to the Short Sellers Journal will be able to add on the mining stock journal at a nice discount.
I know that you were thinking about tossing out that particular issue with this silver company to our listening audience because it's relevant to them. They'd understand silver as an introduction to what you're doing. And would you, how would you like to work that? Would you want people
Sure,
to just come to your website and send you an email, or what?
Sure. Well, if anyone comes in and subscribes after they sign up, shoot me an email and tell me you heard the Silver Doctors episode, and I'll send you the issue that had the silver mining stock in it. It's only moved up a couple cents from when I put it in there, so it's not like you've missed out on anything. And again, this is one of those ones that'll probably take 12 to 18 months to really develop. But if silver takes off, this thing is at least a 5 to 10 bagger with no problem. And they'll understand why when they read that issue of the Short Sellers Journal. And it's, by the way, it's a monthly subscription, so you're not. You sign up through PayPal. It's a recurring payment, and you're only tied into it for as long as you want to keep making the monthly payments. It's not like you're required to buy into it for 6 months or a year.
Are you charging $20? Was it a month?
$20 a month. That's right.
Yeah.
And I'm probably also, I haven't made this official yet, but on the big research reports that I produce, for instance, I'm working on one on Kinder Morgan. I'm probably going to distribute those reports complimentary to my subscribers.
All right, Dave, always a pleasure having you back on the show with us.
Thanks for having me on. I really appreciate it. I love chatting with you guys. You both have great insights, both just from a intellectual standpoint, and I love getting the market color on what you're seeing in the retail physical market, Doc.
Well, hang tight, guys. We could be shaping up for an interesting weekend here with China coming back from the New Year's, and the market's closed on Monday for President's Day. So we'll keep our eyes on the market over the weekend.
Yeah, it's a great
certainly
setup.
is. More volatility is in store for next week, is my prediction.
And higher prices for precious metals, even though, that's the baseline scenario, even though the cartel definitely has every interest in hope and a prayer to keep the lid on things and pressure and attack. A couple of times where you would have expected to see them strike in the last 2 weeks, they failed. And here we are today going horizontal with silver and gold, and silver outperforming gold, and who knows what we're recording this Friday at roughly about noon Eastern time. So we still have to get through the close this after hours close on Friday and whatnot. But silver and gold are doing really darn well considering the strength we see in the equities market and the reflation effort that the policymakers are doing now very clearly. They're overnight worldwide futures just took off, and so we have this setup where the underlying interest in gold and silver are supporting it, when in all other instances where typically we would find ourselves in a condition like we see this week, you'd expect silver and gold to start getting attacked, and it's not being attacked. Or rather, they're failing to get any traction to the downside. And that's pretty darn cool.
From how we've seen gold and silver trade over the last 5 to 10 years, today, Friday's trading action, in my opinion, is just about nearly as impressive as Thursday's was.
Yeah, and it's the same thing we saw last week. Friday we closed out on the absolute high in the access market close. And
yeah, when have we ever seen gold and silver melt up in the access market on a Friday?
It happens every once in a while, and it usually is corresponding when we are beginning to see the effects of a new phase of a managed retreat, as Bill Murphy speaks of. I think that's what we're seeing.
That's a good point, because their favorite time to come in and obliterate the metals market is Friday afternoon when no one's around and the paper market is exceptionally thin.
And what do we have but the paper traders no longer cooperating? They're accumulating paper right alongside the folks in London going in their line to queue up for gold. On all fronts, the normal cartel toolkit is being diminished in its potency given the rise in both paper and physical demand.
So keep your seat belts fastened, and keep an extra large pot of coffee on the burner Sunday night when Asia opens, and then Monday night when the U.S. opens again here. Well, I guess they're Monday night and Tuesday morning. Should be interesting. All right, so we'll wrap up this week's show there. For the doc, Eric Dubin, and our good friend Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.